too stuck in the weeds because I'm going to really try and avoid too many of you sort of looking like this after about 10 minutes. So I'm gonna keep it light and airy for you all. But if we start at the beginning and talk about types of pension. So predominantly in the UK, we have two main principal sort of types of pension. We have the what some might think of slightly more old school defined benefit pensions. So let's think. So these were sort of workplace pensions, often referred to maybe as sort of final salary or career average pensions. Uh, Generally, how much you end up receiving in retirement is going to be related to the period of time you worked in that employment, what your salary might have been, and typically, I suppose, in today's world, if you work in sort of local authority roles or the NHS or maybe a teacher or something, you might still have access to these types of pensions. Um, Unusual in the private sector now for people to enroll into these types of schemes anymore. And then, which brings me on to the second type that we tend to have, and they're called defined contribution pension schemes. So these are generally, they've got lots of different names just to keep it interesting, really. So you might call it a personal pension or a stakeholder pension. Sometimes they're referred to as money purchase. I quite like that term because in the case of defined contribution pensions, what we're doing is we're using money either provided maybe by yourself or an employer potentially to purchase investments that sit inside your pension, and then the subject to what happens to those investments over a period of time is going to you're going to be left with a pot of money. So money purchase, I think, is quite a nice name. And they're the type that we're going to talk about predominantly today because they're the type that are most widely available now in the sort of private sector and more likely to be applicable to business owners. So what are they? They are basically they're a tax efficient way of us saving money for later in life. Like I said, it could be that it's a workplace style one where both you and your employer contribute to it, or it could be entirely personal and something that you've set up yourself, either to supplement something else you've already got from a workplace one, or because you're self-employed or a business owner and you've got your own pension in place that you're utilizing to hive some money away for further down the road. One of the quite interesting things and quite topical things at the moment around pensions is that the UK government, we have one of the most generous pension systems. It's unlike the UK to be generous, but we have one of the most generous pension systems sort of out there, really. And we all enjoy lots of tax perks from contributing into pensions. And apparently, according to the UK Treasury, in 2022 and 23, the cost of the tax relief that people receive on pensions was in the region of £48 billion in that tax year. That's fairly topical at the moment because apparently there's one or two black holes knocking around along with potholes that need filling. So so there is certainly that's certainly an area that might be looked at by the UK Treasury within the next few months because it is a very generous provision. As I said before, we're building pots of money, and of course they're invested in assets. So those assets can fluctuate over time, and obviously the value of our pensions change because of that. And they, of course, for later in life. So under current rules, people can access them from age 55. That rises at the moment. I'm going to preface everything today by at the moment because we've got a budget pending in a few weeks' time, so everything's up for grabs. But that rises to 57 from 2028, and at that point in time, and those points of time, you can access those pensions funds. You might access it as an income. You might buy an annuity with it. You might draw it down. You might take lump sums out of it, or you could have a whole combination of different ways of accessing it. Certainly, any pension that falls under the Pension Freedoms Act that was brought in gives us lots of flexibility about how we might be able to access pensions in the future. Um, uh, as with all things, just to keep it really complicated, we have lots of allowances attached to these things. I've picked up on a few of the sort of most prevalent ones when it comes to defined contribution schemes. So we have an annual allowance. So as individuals, we're allowed to contribute up to £60,000 a year into a pension and claim tax relief on it. There are some caveats around that, and I'm not going to get bogged down in the detail of that. But technically, we contribute up to £60,000 a year and claim tax relief. There's something called the tapered annual allowance that limits high earners on how much they can put into a pension scheme. So people with, and again, there's very specific to individual circumstances, but crudely, someone who earns, let's say, £250,000 a year, £250,000 a year. So we're talking decent people earning significant amounts of money. Because they earn that much money, they may well find that their annual allowance is tapered down to a lower value. So they're actually restricted as to how much money they can put in their pension and receive tax relief on it because they earn such sort of higher incomes. There's such a thing called the annual allowance carry forward that allows us to potentially use unused allowance from previous years that perhaps we haven't made the most. Perhaps in a previous year we didn't have the opportunity to contribute much to something, and this year our income has spiked, so we could go backwards and use up allowance from previous years if potentially. So that can be relevant, particularly relevant sometimes in a business environment. And then finally, the one that I've picked out is what's called the money purchase annual allowance. So at the point at which we start to take an income from pensions, so let's say we've bought an annuity with it, or we're taking money out of it through drawdown, there's then going to become a limit on how much we can reinvest into our pensions. And that limit's at £10,000 a year to receive tax. The reasoning behind that is to stop people recycling pension money. So if you think about it, if you've spent all of your life paying into a pension and receiving tax relief, you then take it out and then pay it back in again, and you keep getting tax relief on the same money over and over and over again. So that £48 million that we touched on earlier starts swelling rather dramatically because we're recycling the money that they've taken out. So the very deliberate allowance stops people doing that. So we've talked a little bit about investment. So what do your pension funds typically invest in? And generally speaking, they'll be invested if you get a pension statement through the door. I'm sure if you perhaps you file it, perhaps you read it, perhaps you pop it in the bin. I don't know, whatever you do with it. You'll somewhere in there you'll find reference to what your pension might be invested in. And generally speaking, they're invested in things called multi-asset funds. And as the sort of name suggests, they're funds that are made up of lots of different asset classes, shares, property, bonds, cash, gilts, all sorts of things. And I've put on screen there a sort of typical wheel of the types of investments that you might find in a multi-asset fund. So you can see there's lots of different types. There's lots of different equities from different geographical locations. And then you can see there's things like corporate bonds and investment grade bonds, maybe some property. That's not an actual fund, but it's just by way of example of the sort of types of things you might find. Typically, people just end up in default funds. Unless you've made a positive choice when you've been either enrolled in a pension or you've taken a pension out for yourself, unless you've very deliberately said, I want to be in this fund or that fund, you're more than likely just enrolled into the default fund, which most people are in. That keeps the fund nice and cheap from just an economies of scale point of view, but it doesn't necessarily represent the right fund for you. Because ultimately different funds, and there's thousands of funds available, ultimately different funds have varying risk profiles, and importantly, varying ESG characteristics. So you might get some people who very much want to be invested in things that are very much sustainably led and so on and so forth. So and that, there's certainly been a shift towards that in recent years. So again, the default fund is unlikely to cover off those bases for you. So just stuff to be aware of, when you're doing your bedtime reading of your pension statement um, at the appropriate point. Um, uh, and I touched a minute ago on risk. So this is a real important consideration for people. And again, something that isn't addressed by default funds. What's your attitude to risk? How do you feel about risk? Uh, that is a emotional state. That is an emotional sensation, whether it's around money, whether it's around uh, rock climbing, as I seem to have put a picture of someone doing in there. How do you feel about risk? What's your sensation around that? And what you're invested in, is that appropriate? Is it appropriate for the level of risk that you're happy or comfortable taking? And then not quite so emotionally led, but equally important, and particularly as we get further down the journey and closer maybe to thinking about accessing these things in the future, what's our capacity for loss? How much can we afford for something to fluctuate? And at what time in life are we at? So, someone who maybe is already retired and is accessing their pension funds to support their standard of living, their ability to suffer a loss is far less than someone like me who's still got 20 odd years probably working ahead of them. So, if COVID happens to me again next month, the chances are the world will recover by the time I get round to thinking about accessing pension funds. To someone who is already accessing their pension funds and COVID happens and everything falls by 25% overnight, that's more dramatic to them than it is to me, because I've still unfortunately got many, many years ahead of me. Um, so, so again, default, sort of plays back again a little bit to default funds and whether, how much do we know about our pensions, I guess, is it just a thing that, we get a statement for every once a year? Um, are you a hoarder of pensions? Do you have people once collected stamps, and now we collect pensions, auto enrollment, particularly for those of us that are employed rather than business owners, means that we collect all these pensions as we go through life. There are some statistics around it, and apparently the average employee could have up to 11 jobs in their working life and move houses and live in 7 different properties. So, that's a lot of pension paperwork and admin going to like the completely wrong place. So it's no wonder that apparently there's some 26, again, Rachel Reeves' eyes might light up at this. There's some 26.6 billion pounds worth of unclaimed pensions kicking around in the UK, and they're made up of crudely 2.8 million pension pots. So, so that's basically 2.8 million pension pots with £1,000 in, because lots of people have had lots of little pensions over the time where they've changed jobs, they get involved in a new scheme. So there's all these tiny little pension pots floating around. And of course, they've moved house 3 or 4 times, and these things just get lost in translation. So let's bring it back a little bit more to sort of business owners, I suppose, and often for business owners, and it's certainly something that I experienced myself, is planning for retirement can be a little bit luxurious at times, because you don't necessarily have the consistent income that someone might have that is employed. Someone who's self-employed or perhaps running their own limited company, doesn't necessarily have a flatline income that they know that they get every month. So it can often be one of those things that gets pushed to the side a little bit, particularly because there's not maybe a third party involved that's going to pay into your pension as well, and sort of to help you along the way. However, there's lots of good reasons to. So, and I've split this between self-employed people and limited company business owners. So, self-employed business owners. So let's, perhaps uh, who's on the call, perhaps the marketing consultant or the a partner of a law firm or partner of an accountancy practice or something or other. Um, People like that who work on a self-employed basis, they've got the opportunity to have you've got the opportunity to have complete freedom around choosing your pension and how it's invested, making sure it's suitable for you. You could change how much you want to, you've got control over how much you want to pay in. If you're an employee, the current legislation says that you have to pay in 5% and your employer has to pay in 3% as a minimum. You're not constrained to these things as someone who's self-employed. You've got complete control over that yourself. Any contributions you make will of course reduce your taxable income. So it's a very tax efficient way of going about saving money for the future and creating a sort of a nest egg in the future. And in fact, and again, this is what causes the 46 billion or 48 billion pound sort of bill to the Treasury. It only costs you 80 pounds to put 100 pounds in the pension if you're a basic rate taxpayer. So you put in 80, the pension company goes along and claims the other 20 back from HMRC. They don't do it instantly. It takes 2 months normally, but it means that that, and that's so it's a very tax efficient way of you of you of you putting money aside. And the carry forward rule that we touched on very briefly earlier, could be really useful. Like I say, if you're what was I thinking of earlier? If you were like a self-employed inventor, like the type that you see on Dragon's Den, and they've invented like a reusable toothpick or something or other, and they're all sat there going, you've solved a problem that doesn't really exist, and so we're not going to buy it. But then one day they invent something that is really amazing. Uh, and of course they then sell it under license to someone, and all of a sudden they've gone from earning in one year very little into the following year they're earning an absolute fortune, because for every unit that gets sold of their invention, they get X amount of pounds. Well, all of a sudden, the carry forward rule might become really useful for them, because they've suddenly got a big spike in income, so they can all of a sudden use previous year's allowances, because in previous years they've not had the money to contribute. That was a weird analogy, I know, but but so that's a little bit on self-employed. Limited company business owners, pension contributions to them with slightly different set of circumstances, because as a limited company business owner, of course, you not only are you the owner of the business, but you're probably an employee of it as well. So you wear two hats. So as the owner, you can contribute pre-taxed company income to a pension pot. So actually, it becomes not just about saving for your own retirement, but it becomes a very tax efficient way of utilizing profits in your business as well. So, and therefore you can contribute to a director's pension, if you like, both as a employer's contribution and as the employee. So the employee gets so let's pick on me, because I'm a limited company owner. So if I make a personal pension contribution, I get personal tax relief on that. If Woodlands Financial Planning Limited makes a employer's contribution for me, that is a allowable business expense. So I don't pay corporation tax on that piece of profit. It's a more efficient. So instead of me paying corporation tax, I use that to make a contribution to Darren's, my employee's pension, if that makes sense at all. There's technically no limit on what a company can pay into your pension, though if you were to exceed some of the allowances we touched on earlier, you could end up with a personal tax charge. But there are such a thing called the wholly and exclusively test. So that relies on the fact that you need to be able to prove it was for the purpose of the business. So let me give you a little example of where that you might fail with that. Certainly, sort of single director-owned businesses would be very unlikely to fail on that. But let's say, for example, you had family business and you employed uh, your your daughter in it and also her friend, and they both did exactly the same job in the business, but you, as the employer, made a massive pension contribution to your daughter, but not to her friend.
Mm.
You're now going to struggle with that test because they're doing the same thing. Your reason for was not a business reason for doing it, it was a personal reason. If you gave them both the same money, then that's fine. But you're going to struggle if you suddenly go, well, I'll give my daughter, put 50 grand in my daughter's pension and nothing in her mates. You're gonna have an issue. Um, Again, so those employee contributions count towards that annual allowance of 60k. And again, the carry forward rule, again, particularly businesses can make use of that as well. So businesses can go backwards and make and fill up previous year's allowances out of their excess, out of their effectively their excess profits. Um, uh, so what, reasons to build pension wealth? Well, we've talked about it already a fair bit. We get a nice healthy tax relief boost. Again, I'm going to preface all of this with at the moment. So we're getting a huge input from the government from in terms of the tax relief that they offer on personal contributions. Plus, of course, as business owners, certainly limited company business owners, we can save on corporation tax by paying into our pensions. Pensions themselves sit inside a protected bubble, a wrapper, as we would describe it. And they get tax efficient growth inside that wrapper. So they don't suffer things like capital gains tax. So if we've invested in this fund A over there, and then one day we decide to move from that fund to fund B, when we disinvest, we don't pay capital gains on the growth that's made. Whereas if it's sat outside a pension, you might be exposed to capital gains tax on that. So whilst the money sits inside that pension bubble or wrapper, as we would normally refer to it, you get very, very tax efficient growth. Again, tax-free cash. So most people would be allowed to access the first 25% of their defined contribution pension pots tax-free. Again, I would preface that with at the moment because there's whispers of that being an area that could be looked at. And legacy planning. Again, another really key thing in pension planning is that defined contribution pensions, generally speaking, sit outside of our estate from an estate planning point of view. So they can be inherited as assets by our beneficiaries or whoever we choose to inherit them, with without being tested against inheritance tax rules. They would still potentially, whoever who inherited your pension could end up paying income tax on it at the point they drew it, subject to all sorts of rules. But it wouldn't. But it would be. But again, it's a far more efficient tax than it being included in your state and being suffering inheritance tax considerations. Again, something that might be under review at the moment. So some have your key takeaways from today then, really. So what I'd like you all to find out, as your homework, is what types of pensions do you have, and what are they doing, what are they invested in, are you making the most of the allowances that are available to you each year? That doesn't mean that we're maximizing everything all the time, because not everyone can afford to maximize their ISA allowance or maximize their pension allowance every year. But are we making the most of the opportunity that we do have? Do the things that I'm invested in match my attitude to risk and capacity for loss? Again, that's a really important thing. And how is that changing as I go through life and maybe get a little older and get closer to the time at which I might actually think about needing to access these things? Am I a secret pension hoarder? Am I one of those people that have got loads of them? The statements come in, I stick them under the mattress, and try and forget about them, and then next year another one comes in. Okay, so today's homework is to go out and get them out from under the mattress, put them under the duvet with you, and get to know them intimately. Start to understand them. Um, um, and of course, how can I utilize my pension to be as tax efficient as possible? Can we, what pensions are really, really good for is controlling income, controlling how much income is exposed to tax. So, if we've got more income than we need, and I know that sounds, like a blissful place to be, obviously, but how can we utilize it to control the amount of tax, the amount of income that is exposed to tax? That's what they're really, really good for. And of course, can my business not only not only contribute to my pension, but make that as tax efficient as possible by helping me to address some of the corporation tax that my business might be subject to if I've had a bumpy year of success and there's money in there's excess profits in the business that aren't being used to be drawn as income or other things. And that's me. So yeah, thanks for listening. It was very low key because it's completely dependent on people's individual circumstances, a lot of it, obviously, and I didn't want to bore you all to death with too many sort of technical things, but if anyone's got any pertinent questions or things that they'd like to ask, then of course I do my best to answer. Jay's raised her hand. Hello, Jay.
Hello, Dan. Thank you
How
for
are you?
that. It's really interesting. I don't think anyone's ever explained pensions the way you have in a simple form for me to understand.
Excellent. Well, good. Thank
So
you.
well done.
Good.
Um, my question is I'm going to admit in this very safe forum that I am a pension
Yes.
hoarder,
No
because
judgment here,
I've
Jay. No judgment.
and now I realise that they've all been um, workplace contribution pensions. So I've enrolled automatically without even knowing half the time.
Yeah.
Um, and I've jumped around, and now I've got three pensions with three pieces of paperwork under my mattress that I'd like to combine as one.
Yeah.
However, when I started to do this, the pension company that I'm with now were useless. So is
Mm.
it somebody like yourself that I would come to with my three and say, how do I amalgamate? Is it
Yeah.
time to review? What's the best thing to do?
Yeah, absolutely. So yeah, a commonplace, Jay, that people, three's not bad actually. I see people with seven, eight, nine, ten of the damn things. Yeah, so absolutely right. So the key thing for me would we need to find out we'd find out a little bit about them, what's in them, what's good about it, what's bad about it, what does charges look like, and then it's a case of reviewing them and saying, well, look, is there a better space for them to be? Would it make sense? So there is FCA best practice guidance that says that people should roll up their old pensions into their current workplace pension.
Mm.
I mean, I'm not a big fan of that as guidance because, again, you just end up enrolling it into something you don't necessarily know much about. I think most of that is driven by the fact that the or potentially is driven by the fact that the pension dashboard project seems to have disappeared. So it was easier just to get everyone to bundle their pensions into one that is to try and get that piece of IT off the ground. Um, but um, but that's me being slightly cynical. So yeah, so really it's a review, what are they doing? And then, okay, if we bundled these together and we don't want to put them in the current scheme, because again, I'm limited as to choice and all that sort of stuff.
Mm.
Where's the best place to look for them? Yeah, and you can DIY that. You sounds like you've had a half a go at
I've
half a go
tried, but
half a
yeah,
go at
it
that.
failed miserably, and I got
Yeah, and
bored
it's not, and
waiting
it's
for them
and
to
it's
do it.
not, it's not as easy. It's not as easy as it like. And of course, I would always suggest that people should get advice around it. So yes, you come and speak to someone like myself, but it can be DIY, but it's not. Uh, it's not that easy to DIY
Mm.
it. And of course, you know, you should look at these things not just as you should start to view these things not just as like a, oh, I've got this over there, but actually what's that going to do for me in the future? How might I need it in the future? How does that tie into what I envisage my working life being? What other assets do I have? Do you know,
Mm.
do I own my own home? Do I, you know, what does my you know, so there's a whole range of considerations we might make about, you know, rather than just, oh, I've got 20 grand sat in something or whatever it is, what do I, you know, what do I do with it? Yeah, so it's a bigger picture, sort of wider piece of work. But yeah, absolutely, someone like myself would help you with, would be glad to help you with that type of thing, I'm sure.
Okay, thank you.
You're very welcome.
I think I'm actually in the same position as Jay as well. I've got two that I know of,
Yeah,
and I attempted to contact both to figure out which one was the best for me, and I had no idea what either of them were talking about.
yeah,
And then they're all going to the wrong address from about 3 moves ago.
yeah.
Um, and the hoops you had to try to jump through, I gave up as well. But
Welcome to
also,
my world.
yeah. So this is why I was really looking forward to today. But also since then, those were all workplace self-enrollment pensions as well. Since becoming a limited company and the
Yeah,
sole director, I haven't paid into anything because I haven't got it sorted. So I'm aware that I need to sort that out. And
yeah.
I'm really, really, really want to get my corporation tax down.
Yeah.
So
Well, yeah, I mean, then you are a prime candidate, Sandra, for, you know, taking probably the potentially the old ones you've got, you know, maybe creating something with them and then you know, and then utilizing a company pension contributions possibly if you've got excess profits in your business, you know, to help A, put money into somewhere for you in the future, and B, reduce, you know, reduce your corporation tax bill,
yeah,
in a try and be as efficient as possible, you know, in the way that we expose ourselves to tax, you know, and make sure we're as efficient as possible, because we, you know, we only get often only get one chance at these things. So once it's gone, it's gone. Once it's gone, it's gone, unfortunately. Yeah. So yeah, similarly, Sandra, you know, it's absolutely the sort of thing that someone like myself would could gladly help you out with.
great. Now, how do we go about getting you kind of on board? Do we have to try and get all the information first and
Yeah, so I mean, in terms of process, Sandra, I would, you know, I'd come and meet with you and get, and in fact, I would get the information from your pension companies in those instances. You,
oh,
you'd
even
give
better.
me, you'd give me permission to do it. Yeah, because the information they would share with me is slightly different to the information they share with you at a sort of retail level. And if you know what I mean, there was so many more technical bump about your pension than they might necessarily just be on your pension statement. So as a process level, you'd give me I'd get you to sign a piece of paper which gives me permission to talk to them on your behalf, basically.
Perfect. Great. Thank you.
So can you help Sandra sort out her change of address problem, or does she have to tackle that?
No, she's going to have, Sandra, I've got to tell you, you're going to have to tackle that one yourself,
Okay.
because I'm going to fail all their security checks as soon as I send off a piece of paper that has got an address that doesn't match. So
Okay.
that would be a piece of work, that phone call to that you're going to have to make to them in the first instance to get that resolved initially, or else I'm going to struggle, because they're just going to say, oh, this person doesn't match that address and all that sort of stuff, and then that world starts to fall down a little bit.
Okay. Sure. Great. I'll attempt.
Yeah, well, yeah, I mean, you know, I mean, it's one of, you know, the reason why people like me probably exist is because most people just, you know, it's life admin-y stuff, most of this stuff, unfortunately. And you know, if you need, people need help with it because they've got loads of other stuff, frankly, that they've got on their plates, you know. So but yeah, again, I'd gladly, you know, if you wanted some guidance, I'd gladly help, obviously.
Amazing. Thank you.
You're very welcome. Go for it, Rob.
You talked about missed opportunities, and I quite recently switched to making pension contributions out of the company rather than taking salary and then putting it back into a SIP, simply because I hadn't realised that the option was there, or indeed that it was more tax efficient, company tax efficient, to do so. So I think it's only the past 2 tax years that I've actually paid out of the company. Can I backdate to say 3 years ago? I think there's a 3-year cap on backdating, isn't there? Can I backdate?
There is, Rob. Yeah, potentially, Rob. I mean, it's all about there's some detailed sort of circumstances around that stuff. But yes, potentially you could go back and backfill from previous years' allowances that you haven't utilized out of your current company year, if you like. But there are detailed circumstance,
Yeah, actually thinking about it, I may be stymied on that because I think I was contributing up to the personal limit anyway in those years via the salary SIP route, because it's only,
yeah, okay.
how long ago was it the allowance went up to 60 from
Last year.
Yes, okay. So in fact,
Yeah, so if
that
you'd
option,
maxed out your allowance in the previous year anyway, even if you'd done it in a different via a different route as a personal contribution rather than a company contribution, you've still maxed out that allowance.
yeah, I committed a corporation tax opportunity, not a pension opportunity.
Yeah, absolutely. As I said earlier, there's technically no limit as to what, in fact, there's no limit as to what you can put in as a personal contribution each year. There's no limit per se. There's a limit on how much tax relief you can, how much tax relief you can qualify for.
So on a company contribution,
yeah,
do I still need to have drawn a fairly large wage of salary against which?
No, so that's one of the beauties. So that's an important point to explain actually. So as an employee, let's just pick an example. An employee who earns £30,000 a year can contribute to their pension, not £60,000. They can contribute to their pension the lower of £6,000 what their income is. So if someone only earns £30,000 a year, they can contribute £30,000 a year to their pension. Okay. Someone earns £60,000 a year, they can contribute £60,000 a year. Someone earns £100,000 a year, they can still only contribute £60,000 a year. Okay. So that's so there's that limit does not apply to company contributions. So you could have an employee working for you, and that could be you or it could be someone else who earns £30,000 a year, and you could you could say, don't worry about paying into your pension, I'll do it for you, and you could pay 60 grand into their pension. That same limitation does not apply which is why it's particularly useful. So again, if I draw on myself just to make it easy, I pay myself a small salary as an employee of Woodlands Financial Planning Limited, and the rest of my income is derived predominantly from dividend payments. So, but I could still make a lumpy, potentially, if I had the money in the business, I could make a lumpy pension contribution as an employer rather than whereas as an employee I would be limited to a much smaller amount because I'm only paying myself a small amount of money. If that makes sense at all. Does that clear that up?
Yeah,
good, thank you. Any more?
Darren, what I suggest we do is, if you don't mind, could we send there is obviously the video, but
yes,
you're happy for us to send your presentation.
Yeah, of course I am. Yeah, I'll fire it over.
And then of course they've got your contact details as well.
Yeah, sure thing.
Because I think people will want some time to think about it, and they
Yeah.
might just stuff your presentation under the mattress. But
Yeah. If there's room, I mean, that's going to get a bit lumpy, that mattress, isn't it?
I'd certainly love to see the presentation that I missed. So sorry I was late.
No problem, Jane. No problem at all.
Well, feel free to ask a question anyway.
Yeah. Feel free to ask something, Jane. Anything. It's fine.
good.
No, I'm good. I just wanted to come and hear you. So I'll wait for the presentation.
It'll be there on YouTube and embedded on the website. So, I mean, echoing what was it Jay said, that certainly this is a very common sense and practical presentation that you just made, Darren.
Great, thank you.
I wonder, Darren, why do you think there are not 1,000 people on the call? What is it about this?
Well, absolutely right. So I mean, it's a dull area, isn't it? I mean, it's just dull. But the reality of it is, it becomes, and I see a huge number of people that get towards the end of their working journey. And then they go, I'm thinking about retiring in a couple of years. I've got all these pensions. I don't know anything about them. I don't know what's in them. I don't know, and it all becomes a little bit hopeful. and a little bit of a wing and a prayer. You know, you know, of course, time is a wonderful thing in financial planning. You know, the more time we give ourselves to in that journey, the better, and the more we ride out some of the inevitable lumps and bumps of performance, of, you know, investment performance and things. But you know, it's just something that people put off. You know, I think in some way, you know, auto enrollment has been amazing because it has, you know, encouraged lots and lots of people to have pensions who, if they purely had the choice, might not. But the problem is as well, in my opinion, at least, it's sort of devalued them ever so slightly as well. Because if you end up in this world where you've got like loads of them, you know, the idea of getting your head around it, where you're back at that picture which I showed you right at the start, you know, you've sort of got your head in your hands and thinking, oh, I don't know, I can find something better to do with my Sunday afternoon than trawl through all this, you know, trawl through all this paperwork. So you know, it is it's a life admin thing, isn't it? You know, and certainly in a busy world, people, it's so easy to find something better to do. Crikey.
Good. Well, 7, 8 people found a very good use of an hour today. So thank you for that. And you've helped a lot of people.